Hello, everyone. My name is Mark Siebert, and today's session is going to be on how to franchise your business. Okay, so let me get started here, and let me start by just saying that today's agenda, I'm going to talk a little bit about the decision to franchise, talk a little bit about how it works, what is the definition of a franchise, what kind of alternatives you got to franchising, talk a little bit about quality control and some legal aspects. I'm going to spend a good deal of time on franchise marketing and on selling a franchise. And then I'm going to talk a little bit about how to create a successful strategy for franchising if we have enough time at the end of the day today. So that will be hopefully our agenda for today. And at the end, maybe we'll have some time for some questions and discussion. So just a little bit about us as an organization. The iFranchise Group is the nation's largest franchise consulting firm. It is rated number one by a survey of franchise companies across North America, a survey of 700 plus franchisors one year and 500 the other, conducted by Entrepreneur Magazine, so an independent survey. And we work with about 98 of the top 200 franchise brands, and the profile of our people typically is somebody who has some experience having worked directly with franchise companies. So we've got presidents, senior vice presidents, head of franchising from some of the best and biggest firms out there in the franchise world. Our average consultant has about 25, senior consultant has about 25 years of experience in the franchise space. The things we do really focus in a few different areas. It's strategy, it's quality control, it's marketing, it's organizational development. And so we also have another related company called Topfire Media. Topfire is a public relations firm and a SEO firm that specializes in helping companies to find franchise prospects. So the company itself has been around since 2013, won a lot of awards, and also has been ranked as one of the top suppliers out there by Entrepreneur Poll. So the people who are here, I'm not going to do a formal poll, but there's really three kind of people that we're typically going to address, and that's people who are thinking about franchising for the first time, people who are franchising but have been doing it for only a short period of time, and people who've got a little bit more experience as a franchisor. By the way, we're happy to send a copy of this presentation to anybody who would be interested in this, and also happy to send you a copy of a video I've done that goes into a lot of detail on some of the strategy pieces and also on some of the legal pieces as well. So if you don't want to take notes, don't really worry about it. So let me start out by talking a little bit about franchising in the U.S. In the U.S., the franchising is defined by law, by Fdc Rule 436. And basically, the rule says that you have to have three elements to be a franchise. So the first is the use of a common trademark. The second is the exercise of significant control or the provision of significant operating assistance. The third is the collection of fees, royalties, markups, or other monies from franchisees. So if you have those three things, and I'm going to shortcut that today by saying name, system, fee. If you get the name, the system, and the fee, you are a franchisor. And if you have something that you're missing one of those pieces, you're not a franchisor, at least under the federal rule. The states, there are some states out there that do have some different definitions of franchising. And so if you're looking for sort of those, they're usually pretty similar. New York is a little bit of an oddball in that it has a requirement for only two of the three definitional elements. One of the things to bear in mind is you don't necessarily have to call it a franchise or use the F word to make it a franchise. People call things licenses all the time that are in fact actually franchises. And so from that perspective, you want to make sure that what you're actually doing is doing something that is going to be legally compliant with franchise laws. Just calling it a license doesn't make it a license. If you have those three things, you are a franchise. So let's talk a little bit about how franchising works. Franchising in general is going to have something like this as a structure. Typically, the franchisee is going to pay an initial franchise fee. 25 to 35,000 is sort of the midpoint in that range, but we see franchise fees as high as 100,000, 150,000. Royalty ranges usually between 4 and 10%. I've seen them as high as 15% in the tax collection or tax preparation business. Advertising typically ranges between 1 and 2%, but again, depends on the industry that you're in. Franchisors oftentimes going to sell product to their franchisees. And in return, the franchisor is going to get initial training. They're going to get operations manuals and systems. They're going to get some ongoing supervision support. And then they may get some other kinds of support services. So it might be that it's a purchasing department that's getting them better pricing. It might be an advertising department and brand maintenance. It might be that they are providing other backroom services like accounting or billing or what have you, research and development, those types of things. So the services provided by the franchisor may vary based on the industry. Franchising today is in a lot of different industries. And when we think about franchising, I think most of us probably think McDonald's. And the fact of the matter is, restaurants are about 25% of franchising. We see all sorts of people today. We're seeing a lot more service-based businesses, both B2B and B2C, and even a lot more, especially medical practices, med spas, things of that nature. We're seeing a lot of senior care. We're seeing a lot of things that are service-based businesses, especially in today's economy. So if you guys are thinking about franchising today, the first real question that you guys should probably try to address is whether or not franchising is right for your business. Now, when we're talking about franchising and being right for your business, there are certain things that you typically are looking for. From the standpoint of the advantages of franchising, you're able to leverage capital. You're able to use other people's money because the franchisee makes the entire investment in unit openings. You're going to be able to grow faster because the franchisee is going to be the one who is going to be doing a lot of the backroom services like finding sites and negotiating leases and working with architects and things of that nature. You're going to get highly motivated management. One of the things that we've seen over and over again is that when you put a manager in a location that was owned by a corporate location and it becomes a franchise-owned location, we'll see sales boosts of between 10 and 30%. And we got dozens of anecdotal evidence on that kind of information. Obviously, there's reduced risk since you're not the one putting the name on the lease or signing any of the leases for any of the equipment or buying any of the things that go into this. Fewer operational concerns. Somebody calls in first thing in the morning and calls in sick. It's not you that has to go there and fill that role. It's going to be the franchisee who's going to do that. Typically, it's higher quality, and that's one that sort of surprises a lot of companies that are new to franchising. They oftentimes will think, well, if I can't control them as easily as I can control an employee, then I may not be able to have the same level of quality. But the fact of the matter is, when you're franchising, you're normally going to get somebody who is a better candidate than the typical person who is looking to be a manager of some location. You're typically going to get somebody who's going to be there long term. Somebody who might be there for, could be years, decades, or a third generation McDonald's franchisees at this point. And you're going to get somebody who's highly motivated to make sure that the operation runs really well. Organizational leverage, obviously there's certain things your franchisees will do on your behalf, things like the build out of the unit level, things like the hiring, so you don't have to have a big HR department. The franchisee is doing a lot of that stuff. You don't have to have a big accounting department. Franchisee is doing a lot of those things. On the downside, you have to share profits with your franchisees. So when this is of course assuming that the units are profitable in the first place. So for example, in the last year when we had some businesses that really weren't able to make a profit, some of the companies that had a lot of corporate-owned locations ended up going into bankruptcy. Whereas if they had a lot of franchise locations, a lot of times the franchisees would, be able to, work a little bit leaner. They'd have their families working in the businesses. They'd be able to sort of dip into their savings or whatnot. But they're not losing. The overall franchise corporation was not losing money on hundreds of stores that are out there in operations. But generally speaking, in a non-COVID kind of environment where your business hopefully is making money, your franchisee is going to make more of the profit than you will out of a profitable unit. There is less control, although the kind of control that you do have is pretty significant from the standpoint both of contract and from the standpoint of being able to make sure that somebody uses your brand just the right way because of the fact that they're highly motivated. And relationships with franchisees do take work. It's not as easy as the typical relationship in which a franchise, which you might have with somebody who's not a franchisee, where you can just say it's my way or the highway. In a franchise relationship, you're going to treat these folks more like they are your, and the lawyers hate it when I say this, but more like they're your partners, certainly more like they're fellow businessmen with a common interest. One of the things that people do talk about franchising is that it's litigious. The fact of the matter is it's really not. About 25%, 27% of franchisors report any litigation. And that includes large companies that, somebody like McDonald's who has 30,000 plus franchises is going to have to report that they do have litigation. But when I looked at the McDonald's, it was, they had, the last time I looked at it, they had 6 pending lawsuits with a litigation rate of 0.2%. So 2 people out of every 10,000 franchises, and they were suing them for things like making their children obese and beef tallow in the cooking oil. Somebody says that they make the chicken in an unhealthy manner. The fact of the matter is those are not franchise-related issues, but they were the disclosed litigation, and it's just because, again, McDonald's has that big target on their chest. So from a franchise standpoint, one of the things that we typically see is that from a liability standpoint, well-executed franchising will have some increased contractual liability, but that increased contractual liability is going to be a function largely of a contract that is very one-sided and is very much in favor of the franchisor. On the other hand, with company-owned growth, you have the employment liability, you have the property lease liability, you have the equipment lease liability, you've got workers' comp, slip and fall. You're always going to have what would normally be vicarious liability in a franchise because the people that are operating in your locations are in fact your employees, and you can have a third party insure you against liability in a franchise as well as insuring it internally. So frankly, the litigation exposure from franchising is a lot less than corporate locations. Now, if you're thinking about franchising, probably the first thing that you should be doing is you should be looking at the corporate growth option as an alternative. What I encourage people to do when you're thinking about franchising or any kind of growth plan is to start with your goals. So start by being very specific about what your goals are, where you'd like to be, and when you'd like to get there. So do you want to sell the company? If you do, how much you want to sell it for and when? Be careful that you don't just say some generalization like I'd like to sell it for as much as I can and as soon as possible, because that is not really being very specific. Then ask yourself, what is your risk tolerance? How much of the profits that you've got right now can you reinvest? How much money are you willing to invest right now in your growth? And are there other resources that you can bring to bear from the standpoint of moving this thing forward? And then once you've done that, what we recommend is that you do some kind of a cash flow analysis to see if you can reach those goals. So as an example, let's just say that you wanted to sell the company for $10 million at the end of 5 years. Just using round numbers here. Right now, you've got a couple units in operation. Your total equity investment in a new operation would be $150,000. Your total available capital in the bank is $200,000. Your free cash flow right now is $100,000 a year. The units break even in the first year, and they return $50,000 per unit after that. This sort of assumes that there's no incremental overhead, but just a very oversimplified approach to showing you what this might look like. So you start, and again, for those of you who are accountants in the room, this is a very oversimplified model. If I showed you something that would be the way that you really look at this, it would be much more complex than this. But sort of the short version is, based on those assumptions, you could open one unit in the first year. You'd have a little bit of money left over from cash flow. You'd have the ability to open up a second location in the second year, a third in the third year, another one in the fourth year, and two in the fifth year. And by the end of year 5, you would have a cash flow of $350,000, and you'd have a value of the business about $2.5 million, assuming 7 times multiple of cash flow. So that would sit there and tell you that in that scenario, you could not get to that $10 million goal. So at that point, you need to have really more like $450,000 of free cash flow in year 6. Still only gives you 3.1. What you'd really need to do is you'd really have to get to about 27 corporate locations in this example. It would take you about 12 years of reinvesting everything, and it would be about a $4 million investment over that time frame. So what you'd sort of say to yourself is, I really can't get there from here. So what are your options? Well, your options are you can change your goal. You can say, $3 million is pretty good. Or you can say, I want to do this, but I'm okay with going to 12 years. Or you can change the structure, or you can raise equity. But basically, it's changing your strategy are those last two options. So if you are going to raise equity, your next option is to say, how much am I going to give up in my company, and how does that impact my goals? So the first thing is you have to factor in dilution. And dilution is what happens when a company gives up shares of the company. So if I gave you 50% of my company, when I sell the company, I'm only going to get a selling price on 50%. So because I am half as invested in the company, I need to grow the company twice as big to hit the same goal. Now, if you do that, you'd sit there and you'd say, in the case of raising this equity, you would say, well, if I bring in $3 million, and again, this is oversimplification, if I brought in $3 million and I began to reinvest in the first year, I could then open up 15 locations. That might require some additional staff, but let's just say that it didn't. Existing cash flow is $100,000. I've got 17 units at the end of the first year, and then I start reinvesting year after year, 7 the next year, 5 the next year, 8 the next year. And by the end of year 5, I'm at 1.8 million. By the end of year 6, I'm at about 2.7 million, which is a 19.25 million valuation. So I'm about where I need to be, given that I've got a 50% of the ownership. I need to get to, I'll get about a $9.6 million gain on that business. Now, the problem here is that while you can do this and you can get in there with an equity infusion of about 3 million, you still need to get to 50 to 54 units. You have to be able to invest a lot of money to do that. And the good news is you're using other people's money. The bad news is that from the standpoint of valuation, you have to look at it the way that an investor looks at it. So when you're looking at the way that an investor looks at it, they're going to say the value of the business back in year 1 was about $700,000. The value of the new entity, where I put in $3 million of my cash money, is $700,000 plus that $3 million, $3.7 million. So sophisticated investors are going to want $3 million, which is the amount of the investment, divided by the $3.7 million, or about 81% of the company. So while you might be able to find an investor who's an angel type investor who would do $3 million for 50%, the chances are that it's not going to be as easy to find that person as you might think. And at some point, it just isn't realistic anymore. And so one of the real issues is really, sort of that valuation issue. You guys have all seen Shark Tank, probably, where Mark Cuban is saying, what are these guys thinking? And so what you really need to do is say, if you can't get there from there, what am I going to do? And so you've got some alternatives. So some of the alternatives to franchising, obviously, we said before, it's sort of the shorthand, name, system, and fee is a franchise. But if we look at this from the standpoint of taking one of those away, we can take away the system and we'll have a trademark license. We could take away the name, we'll have a business opportunity license, or we could take away the fee and we either have a distributorship, a dealership, an agency, a sales rep, or a JV. So those are sort of the options. And you can combine these options if you want. So you could be a franchise and a joint venture partner if you have somebody where they're paying fees, but you're also sharing equity. You could be a trademark license plus a dealer distributor. So for example, one of our clients, and we don't do just franchising, so I really don't have a horse in this race in terms of guiding my clients one way or the other. But so one of my clients is Swarovski, and they do this system, which is not a franchise. It's a trademark license plus a distributor agreement. So that is one option. Now, different options have different sort of advantages and disadvantages when you're looking at which way to grow. In terms of the advantages of a trademark license, it's going to be less regulated, although it still will probably trigger the fee or the franchise definition in the state of New York. And then you're going to have typically lower fees. And the question is, how strong is your brand name? You have very little control over the brand in this because you're not dictating the system. You're not exercising significant control. And then the question is, how strong is the brand name? So if you are Michael Jordan and you're putting your image on Nike shoes, that might be something where we'd have the ability to do these deals very readily. But for most of us, it's pretty difficult to have a brand that is that important and that valuable. And the other issue is that if you're doing this with a business, it's going to be very easy to step over that line into providing that significant control or assistance. There's 18 different elements that can trigger it. So the next thing is you could be a business opportunity. So in a business opportunity, what you're looking at is you're looking at a situation where you've got less regulation. And while there's less regulation at the federal level, there is more regulation actually at the state level. So there's 26 states that actually regulate business opportunities. From a disadvantage standpoint, you've got lower fees. The second thing is you're not going to be able to build a brand, right? So right now you may not have the world's strongest name, but once you open up 10 locations or 50 locations, you will have that strong name. But you won't be able to do that in a different situation where you might not be using your name. So that lack of control is basically because if you don't have a name, you don't have a contractual nexus to say that you must do things my way. So if I'm McDonald's, I can insist that you have a Big Mac. If I'm Mark's Burgers and you're Bill's Burgers, there's no reason why I should control what goes on in Bill's Burgers because I don't own that brand. So essentially what ends up happening in these kind of situations, oftentimes you create your own competition and you have multiple people competing using the same systems in the same market, usually leads to price competition and a poor image. Now it can be a good option for some, but again, ask yourself some of the questions. Will you have national accounts? Do you want to have brand loyalty? Those kinds of things are going to be important to you. The next is going to be whether you want to be a dealer or distributor. And I don't know if anybody today is a manufacturer, but the key here is you have to not take any fees. So all your support is free. The products that you provide are going to have to be sold at a bona fide wholesale price. It cannot be something where you're building in some kind of incremental fees on top of that. The thing that you need to be very careful about is you want to make sure that your products are not treated as some kind of a stepchild here. And again, it's very easy to step over the line into accidentally collecting fees. And people don't realize how easy this is, but just to give you one example, there was a case where this happened with Mitsubishi versus one of their dealers called Toam. in Illinois. And what happened in that particular case was that TOAM collected or paid fees to Mitsubishi over the course of an 11-year relationship. And those fees totaled about $900. So it was not a big amount. And all that was happening is there was some well-meaning clerk in the Mitsubishi office that said, if we're going to be providing all these books to, on these manuals to the client, we should at least make them pay for the cost of duplication. Well, that fee element is triggered at $500. And once they had gotten to $500, it went from being a distributorship to a franchise. It cost Mitsubishi $3.2 million in that particular lawsuit. So you have to be very careful about those types of things. The next thing that you've got as an option is sort of the agency or sales rep. And again, this is like an insurance agent or something of that nature where they're selling. And this is essentially what we call a top-down model. So in this, essentially, I am providing the service to my ultimate buyer, but I've got somebody in between who's going to sell on my behalf, but the contract is ultimately executed with me. I'm the one responsible for delivering. So because all the money flows downward in this particular scenario, I am not taking a fee. And again, you have to be very careful about not taking any fees. There are other options that you've probably seen out there these days. You've got the technology-based app services. Essentially, this is a top-down fee structure, places like Lyft and Uber and Airbnb. And then you've got certification programs. Now, certification mark is not a trademark. It basically says that that anybody who has passed this training can use this as being certified, or past whatever that standard is. But you can't have exclusive territories, and you can easily stray into a franchise relationship with something like this. So you have to, one of the things is you have to offer it to anybody who qualifies under whatever your guidelines are. So it's a little bit different than what typically is typical of franchise. So when we're talking about sort of the laws that govern third-party relationships, the laws are, sort of a mixed bag. But regardless of what you are going to do as a business owner, you need to make sure that you hire a good attorney that can handle this. And I always recommend that you would look at a franchise attorney, even if you're not going to be a franchise, just to make sure that you steer clear of franchising or business opportunity laws. By the way, I don't do the legal documents. I don't do, I'm not a lawyer. And so if you want to talk to a franchise attorney, I'm happy to make a referral to someone who can help you with that. And I don't take any fees from those attorneys. I don't take any referral fees or anything. So I'm pretty much out just to make sure you get good representation. So anybody like that, just let me know. But regardless which way you go, make sure you get a good qualified attorney. Now, when it comes to time to deciding on the right growth vehicle, again, I go back to make sure that the decision is based on your goal. So how far distant is your goal? How fast you need to get there? What obstacles are in the way? You want to make sure that you have a good understanding of that, and make sure you have a good understanding of your own risk tolerance as part of that process. Also, make sure that you're looking at this from the standpoint of, are we trying to build a Volvo or are we trying to build a rocket ship? How fast are we trying to grow? And there's different ways to go that where you don't have to choose just one vehicle. You can be franchise and company-owned growth. You can do franchising and joint ventures. Whatever you do, though, what I tell people is don't decide to franchise or whatever. What you should do instead is figure out what your ideal scenario is in terms of growth. So ask yourself, do I want or need to build a third-party channel of distribution? If the answer to that is yes, then do you want that channel to be branded? If the answer to that is yes, then do you want to control the quality that goes through that brand? If the answer to that is yes, ask yourself how you want to be paid. And if the answer is yes, 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 and I want fees, then you're a franchise. And if the answer is something else, then you're something else. And you just need a good lawyer to put together the right paperwork. What I tell people is don't let the lawyer or the law or the know-it-all Uncle Charlie dictate what are good business decisions based on what they're calling it. franchising or licensing or whatever, it should be a decision that you make based on you've made good business decisions about the structural element of your growth model, and then you look at what it is once you've made those decisions. And if it turns out it's a franchise or a license or a JV, then so be it. So let's assume that maybe you are still interested in franchising, and that's something that you're looking at moving forward with. When we're looking at franchisability, we really look at a few different things. The first thing we're looking at is whether or not we can sell franchises. And that's going to be a function of things like, do you have a successful prototype? Do you have the credibility in the marketplace? Or are you getting lots of hits on social media, those types of things? Do you have some differentiation from your major competitors? Are there people out there that are helping you to differentiate? Is there some brand sizzle to this? From the standpoint of buyer appeal, is there a particular buyer that this is going to work for? So are you selling a dental franchise to dentists? The more narrow you can do that, the better off you're going to be. Then from the standpoint of the value proposition, what is it you're providing to your franchisees? The next thing we typically look at is whether or not you can clone the business. So that's a question of teachability, whether or not it's going to work in a variety of different markets. There's some concepts that just don't, might work in one market, but don't in another. If anybody here is from Cincinnati, you've seen the Cincinnati style chili, but you don't see that down in Texas, where frankly, if you try to sell that in Texas, you have some real problems because it really doesn't taste at all like a Texas style chili. Ask yourself if the business is systemized. If it's not, there are companies like ours that can do that for you, but you have to make sure that you've documented how those things would work. The next question is really return on investment. It has to work for the franchisee, both from the standpoint of how much they're going to invest in it and from the standpoint of how much they can make from it. And then there's the question of sort of the overall factors for success. So when you look at things like, the market trends and, what's going on in the marketplace, availability of capital and strength of management. And what I would tell you is the one that makes the most difference in terms of the success of most clients is going to be strength of management. Good management can find capital. Good management can adapt to changes in market trends and changes of competitors, but there's no cure for bad management. Ultimately, what we want to do is we want to create a win-win-win scenario for our franchisees so that the consumer feels that they've got a good buying decision and comes back for more. The franchisee feels that they have invested in a business that is a win for them, and it's a win for you. Now, I'm going to give a little bit more detail on sort of return on investment hurdle rates. What we talk about when we're talking about how much the franchisee needs to make, they need to make a return on their time, first of all. So that's no different than if they, instead of working in the franchise, went out and got a job. So they should be able to get a salary if they're working in the business at a market rate. If they're an investment banker, they don't get an investment banker salary. They get, the salary of whatever it is, whatever job it is they're taking in that particular unit, because they could always hire somebody to do that, and that's the underlying assumption. The next is they have to make a return on investment. So it's no different than if they invested in the stock market or if they invested in bonds. Over time, you'd expect to get about a 3-4% return on bonds. Over time, you'd expect to get about a 10% return in the stock market. Franchisee is going to be able to get a certain return on their investment, and they should be able to cash it out at the end of the term by reselling the franchise to the next franchisee in that system. Now, franchisees expect that they're going to need to build their business, so they don't necessarily think that they're going to get this return in the first year. But what we're looking for is about a 15% cash-on-cash return for somebody who's going to be an owner-operator plus a salary, or 20% for an area developer since they have additional overhead to support. Now, if you want to look at how this works, and again, for the accountants in the room, this is a very oversimplified analysis, but let's go back to that same investment that we were talking about, where we said, we can open up a business for $150,000, a franchise fee is $25,000, we need some working capital. Our total investment in opening up a franchise might be $200,000 then. So if the estimated revenue at maturity for this business is $500,000, what we then do is we'd say, let's look at the profitability at maturity. and let's say it's 70,000. Now let's make some adjustments to that. So we might adjust our owner's comp because we're overpaying ourselves or underpaying ourselves. We might look at adding back in one-time only investments that a franchisee would not have. Maybe you had to pay for a trademark. Maybe there's some tax minimization strategies, which is sort of the things like the car and the country club to get written off. Shared overhead between locations, interest, debt service, depreciation, amortization. We'd add those all back into the profit, and then we would subtract out incremental royalties or price adjustments on a product that we would sell to our franchisees. And that would give us a adjusted profit in this particular case of about $80,000. So that $80,000 is relative not to the sales, but it's relative instead to the investment. So we divide by that initial investment of $200,000, and that gives you a cash on cash return of 40%, knowing that at the end of the term you would be able to resell that business. If you sold it for 5 times earnings, you'd sell it for $400,000 as opposed to $200,000. So that's a really strong return on that business. And that's, again, sort of shorthand for how you would do this kind of an analysis. Now, if you have a business that is franchisable and you're looking at sort of moving forward with that, the next question is, should you perfect that business before you have gotten to a point where you are ready to franchise? And when we're talking about perfecting the business, if you think you've perfected any business, you should probably sell it, because the fact of the matter is you have not perfected the business. Things are going to change over time. That's just the nature of businesses. If you're standing still, somebody's out there gaining on you. If you look at this bottom right-hand corner here, this is the McDonald's menu when they were first starting in 1955. So you look at that menu and then say to yourself, what does that look like in terms of today's menu? And, frankly, it doesn't look anything at all like it. So when we're looking at something like that, we want to make sure that we understand sort of exactly the fact that we do need to adapt on a going forward basis. So now when we think about this, there's a article I wrote a while back called Quick versus Slick. And essentially what that says is that if you're going head-to-head with highly established competitors, if you're going head-to-head with McDonald's, make sure you refine that business first. So when Five Guys came out into the marketplace and they were going head-to-head with McDonald's and Burger King and Wendy's, they had already built out a dozen different locations and gotten them to profitability before they started franchising. On the other hand, if you are unique in the marketplace and you are thinking about when you should franchise, the risk that you've got is there's somebody out there with a camera and a notepad who's going to be looking at knocking off your business. So, for example, when we worked with John Leonicio over at Massage Envy, they had one unit in business for 3 months when they started franchising. They knew that there were going to be people knocking them off, and they wanted to get to the market first and fastest. And today they've got over 1,000 locations. So when we talk about this, think of it from the standpoint of the risk that you have in your business model is going to go down over time. And that risk is going to be reduced because you know more about how to operate the business the longer you operate. On the other hand, the risk of competitive threat goes up over time. And so when we look at sort of those two risks, everybody has to judge for themselves where this intersection of these 2 points is, where this equilibrium point is. But ultimately, that will tell you when you should start franchising, because the risk of competition is greater than the business model risk. And so just for fun, I got some slides in here of some companies that just got started in franchising when they first started. And so obviously you recognize Pizza Hut, the first McDonald's, Dairy Queen. This one's a little harder. This one is the first KFC, Sanders Cafe, Colonel Sanders, first Radio Shack, and here is the first Subway. Not exactly what it looks like today, but that was first. So when we talk about first mover advantages, being the first in a marketplace, if you do have something that's new and unique, is going to provide you with some significant advantages. So if you look at companies like, in the burger industry, the oldest company in the burger industry is probably White Castle. Beyond that, it's Crystal. Crystal started in 1932. White Castle never franchised, so I didn't put them in this analysis. But White Castle, Crystal was founded in 1932, Burger King 1953, McDonald's in 1955. When they first franchised, 1955, 1961, 1990, that tells you sort of when they started their expansion program, and it gives you an idea of where each one of these are in terms of the speed of growth that they were able to achieve just by being first into that marketplace. So there's a substantial advantage to be first in the market when you're doing something like this. Now, when we talk about how to succeed as a franchisor, there are certain things that you need to do in order to be successful as a franchise. First is you want to make sure that you have a good strategic direction and a good business plan. Now, when I talk about a business plan, I'm not saying I want a business plan just for the sake of having a business plan. I'm saying I want a business plan because I think that it's important to make good business decisions, and that's what I'm looking for there. So it's not so much having the plan as it is going through the analysis to get to good business decisions. Legal documents, you'll need operations manuals, training programs. You need to market the franchise and have something to convey that message to people. You need to advertise, and then you're going to need to design and implement a sales strategy, and you have to have the capital and the staff in place to implement that plan. So let's talk a little bit about strategy. One of my favorite quotes, if you don't know where you're going, any road will take you there. I think that's, again, look at where you want to be as being the end product of this analysis. So the next thing, from a strategy standpoint, the keys to success, I would say is, number one, understand that you are entering a new business. And by that, I mean, you're not getting out of the old business. What you are doing is you are entering a business in which you are going to be selling and servicing franchisees. So your job is going to be sell the training and the support that you provide to franchisees, and then providing that training and support. And that's the new business that you're getting into. Remember that your goals will drive your success. So start with those, start with your support and your cost structure and move on from there. And what I say is, again, the most important thing in franchising, and I'll probably say this more than once today, is that in order to be successful as a franchisor, you need to make your franchisees successful. That's the most important thing that you can possibly do as a new franchisor. So when you're looking at something like that, don't rely on guesswork. It's really about doing your homework, building that plan, doing the financial modeling, and reverse engineering your success. So again, when we talk about reverse engineering our success, let's go back to that same goal we talked about earlier, selling the business for $10 million at the end of 5 years. We're looking at selling a business for $10 million in 5 years, and the average selling price for a franchise business is 6.7 times earnings before interest and taxes. Then what we can say is, by dividing the 10 million by the average selling price, we need to be earning about 1.3 million in order to be able to get that as a selling price. Now, if our average royalties at 6% of 500,000 are $30,000, then we ask ourselves, what are we going to put to the bottom line? Now, again, this is a very oversimplified analysis, but if we ask ourselves that, a best practice franchisor, top quartile franchisors put between 35 and 45% to the bottom line based on some International Franchise Association studies. So if you are able to put 35%, 33% to the bottom line, you're going to net about $10,000 per franchisee. Well, you would then divide that into your earnings, and you would say that you would need to sell about 130 franchises to be able to get to the point where you can sell that business for $10 million. And that's more than the 70 million, the 50 to 70 businesses that you would have to open, if you're doing it company owned, but it's, probably twice as many, but obviously much less from an investment standpoint. Now, at this point, now what you do is you start to say, what does this look like if I'm sort of driving this from a goal standpoint? We like to see this sort of hockey stick effect in terms of the way in which you grow a business. So we like to see this, starting slower and then getting more aggressive. People pay higher multiples for those kind of companies, and it lets you get your feet under you. So we build in, here's what we need to do to get to that 130 number. Once we've done that, now we sit there and say, when do we need to hire people? We know, for example, that a franchise salesperson should be able to sell 20 franchises per year. So we know when we're going to hire the franchise salesperson. Depending on the industry we're in, we might be able, so certain industries they have different staffing ratios relative to field representatives. So we might sit there and say, here's where we need to hire our field reps. Here's where we need to hire our support staff. And in fact, we can figure out everything, starting with personnel to marketing to office space to brochures, based on knowing what this is. So we know, for example, that we are going to have 10 franchises in the first year. We think that our close rate is going to be about 3%. So we know that for every 10 franchises we're going to sell, we need to have 300 brochures. So you can get down to that level of granularity when we're developing this kind of an analysis. The cost of a franchise program and getting into a franchise program, depending on how aggressively you're looking at it, could be $50,000 to $200,000 or more. But again, it depends on how aggressive you're looking at it. And I'm going to go through more detail on that a little bit later. Now, when people are developing strategies for their franchise growth, one of the big problems is that they take sort of a ready, fire, aim approach, and they just sort of say, well, let's do it this way. Or they'll go to an attorney and they'll say, well, what do you think the royalty should be? Or what do you think the fee should be? And, frankly, those kind of decisions that are made sort of in a haphazard manner are what can be the downfall of a lot of new franchisors. Me Too, where somebody says, well, I saw somebody else and they did a 5% fee or 5% royalty. It really sort of assumes a lot of things that just aren't going to be true. Me Too assumes that the businesses are going to be the same, that the unit economics are going to be the same, that there's no differentiation between the businesses, that the support structure that's going to be needed, the marketing that's going to be needed is all going to be the same. And it also assumes that the first person who's in there or somebody's in there as a predecessor to you has done everything right, and they're not making mistakes along the way. So these things can oftentimes lead to some substantial failures. In fact, I had a particular client at one point in time who came into me, and I won't mention their name, but they came to me and they said, we'd like to figure out what's wrong with our franchise program. We're losing money, and they had 50 units in operation. And I said, you guys, I'm glad you came in because you guys are on death's door. This is a horrible franchise structure. And I started to tell them why. And they said, that's obviously not the problem, Mark. They said, we took this structure from Tasty Freeze. And I said, well, I don't really care. And as it turned out, the structure that they had developed, a year later, Tasty Freeze went into bankruptcy. And 2 years after that, they followed it in. So again, you have to make sure that you're doing things in a way that makes a lot of sense for you. Now, I'll give you an example that's a little bit easier to quantify. So let's assume that we make a 1% mistake on a royalty. Let's assume that we should have been at 7%, but we were at 6%. That 1% on a $500,000 revenue business is going to be $5,000 right off the bottom line, right? So we didn't have any associated expenses. It was just a mistake we made. I can pretty much guarantee that none of the franchisees are going to ever sit there and say, hey, you're not charging me enough. So what's going to end up happening is that structure is going to get inculcated into your business oftentimes, and that inertia will keep you at that level for who knows how many franchises. Well, let's say that you open 100 franchises. That's now 100 times that 5,000 mistake. That's a $500,000 mistake. But it's not a $500,000 mistake once. If that contract term was 20 years, that's a $500,000 mistake times 20. And if you look at being able to sell your business as a franchisor, maybe you can get 10 times earnings. Well, if you got 10 times earnings on 500,000, that's another $5 million that you don't get when you sell the business. So that 1% mistake, when you sat there and said, well, I think it should be 6%, and it should have been 7%, that's a $15 million mistake. And there's a lot of decisions that are like that, things like the structure, things like the targeted franchisee, things like territory. These can be easily multi-million-dollar mistakes, margins on product sales. So when we're looking at these kinds of things, it's important that you really dig in deep and make sure that you understand what the implications of these things are, because essentially franchising is growth on steroids. And if you make a mistake, you're repeating that same mistake over and over again multiple times over the course of a very short period of time. The faster you grow, the more mistakes you've made. And if it is mission critical in terms of the mistake, it is the end of your franchise program. One of the other things we talk about from a strategic standpoint is how aggressively should you grow. A lot of people come in and they say they want to sell a bunch of franchises really quickly. Now, when that happens, if you want to sell aggressively, and some of our clients have done this, you have to hire staff in anticipation of the need, and you have to advertise aggressively. So you can't sit there and say, I'm going to hire a field support person when the time is right. You've got to hire that field support person right away. You've got to hire, the training person right away, because you're going to have so many franchises coming in. Well, what ends up happening is you have higher fixed costs plus higher advertising costs. And so as your royalties start kicking in, remember royalties are where you make your money, you've got to be able to cover this area of loss as a part of your proposition, your growth proposition. And there's only three ways that you can do it. You can either be initially capitalized enough to fund it, you can get revenues from your existing operations, or you can do it based on franchise sales. But using franchise sales to fund your growth is a worse practice. If you do that, the problem is that you're going to end up lowering the standards for your franchisees. And in the process of lowering the standards for your franchisees, you're going to take on franchisees that are going to cause you headaches down the line. Now, what we normally recommend for most of our clients is to start off more conservatively. You can leverage off your existing staff, you can do some more minimal advertising, and you're going to have a very small area of loss that you have to cover when it comes time to initially doing this, and it's basically going to be your increased advertising costs. Then what you do is you start hiring people underneath your royalty flow. And if you do something like that, while you grow more conservatively to begin with, you are able to make a better use of your and a more conservative use of your growth. And again, the thing that's important more than anything, don't go any faster than your ability to support your franchisees. So again, franchisee success is absolutely critical here. Now, when we talk about quality control, we talk about sort of a trade-off. And the trade-off that we talk about is that, a lot of people think that franchisees have a lower level of quality. We talked about a little bit about this earlier, but just the opposite is true in terms of the scores that we see. And the trade-off is essentially that while you don't have the same level of control, you do have higher caliber people. You do have people that are there and are more highly motivated, and they're going to be there longer term. And so our studies have shown that franchisees will outperform in terms of both perceived stores. So we did a project, for example, for Texaco, where we took corporate locations and sold them to franchises. This was in the United Kingdom. And the perception scores of those were graded on a scale of 1 to 100. They went from 87 to 94. So by putting franchisees in those locations, they were able to improve the perception of the location in that process. Lots of anecdotal evidence to sort of back this up. Now, from the standpoint of what you need to do from a quality control standpoint, there's really four things. Number one is select good franchisees. This is probably the absolute most important thing that you can do as a franchisor. Make sure that you're selecting good franchisees, because the quality of the franchisees are going to be absolutely paramount to your ability to make sure that these people are going to be successful. Bad franchisees are not going to be trainable. They're going to do things the wrong way, and they're going to end up just being a pain in the neck for you for a long period of time. The second is make sure you have good documentation and training. So good operations manuals, good training programs. Those are the tools you're going to use to help you with the franchise process. The third is from the standpoint of support. Make sure that you're supporting these people, giving them the training, visiting them, communicating with them, being with them as frequently as possible. And then last is legal documents and compliance. I did a presentation with somebody else the other day, and they said compliance should not be a bad word. Making compliance a good word should be something that we should strive for as franchisors, and I really like that. The fact of the matter is, usually your franchisees are going to be the ones who are going to be most vociferous when it comes to saying that you need to do a great job of compliance, because they want to make sure that everybody is living up to the same brand standards. But if they don't, you have to be ready to enforce your legal documents. You need to be ready to sit there and say, either you comply with the program or you have to lose your franchise. And you can do that in a franchise program. Now, each one of these comes with a cost, of course. So turning away franchisees, providing and developing great documents, having higher staffing ratios for support, developing great legal documents, or potentially losing franchisees who won't comply. Those all come at a cost. But if you exercise that cost, you'll be able to control quality oftentimes much better than you can in any other kind of situation. Now, when it comes to that top criteria, which is the qualification of your franchisees, there's some things that are just sort of givens, right? So the top three, intelligence, capitalization, and work ethic, are really, true of pretty much every franchise. If anybody here knows of a franchise where you don't need to be intelligent and well capitalized and have good work ethic, let me know, because I've got a great brother-in-law that I'd be happy to introduce to the franchisor. But that being said, stupid, undercapitalized, and lazy just doesn't work. But people don't say that to you when they're in the interview process. When you're trying to find out if they are a good candidate, they're not going to say, I'm stupid, undercapitalized, and lazy. They're going to say something more along the lines of, yeah, I work really hard and everything else. So you have to make sure you're asking the right questions. The other things that you're going to look for, personality. Are they a cultural fit for your team? Different people have different kinds of cultures, and you need to make sure, are they confrontational or are they adaptive? Are they compatible with you? Because for the next 20, 30 years, they're going to be your franchisee. Are they too entrepreneurial? Are they asking questions about, when you start hearing people saying, did you think about doing it this way? And they haven't even gone through their initial training yet. That's when you know you got somebody. Maybe it's going to be a little bit too entrepreneurial for you, so you'd have to look out for them. And then there's sort of the job-specific qualification requirements. And when we talk about those job-specific requirements, what we're typically talking about is, do you need somebody who's a salesperson? Do you need somebody who's a great manager? Do you need somebody who understands finance? What is it specifically that these people have to be able to do? You don't want this guy as your franchisee, right? You want somebody who's going to be a little bit more rational in the process. Now, I talked a little bit about franchisees being a little bit too entrepreneurial. I tell you that when you talk about a franchisee, the best franchisees are sort of the straight A students. They've got a long tenure with their job. They've probably been in a corporate job for a long period of time. They drive the family car. They don't get lots of tickets. They're typically married, and they're typically looking for security. They are people that drive the station wagon through the right-hand lane of life, and that's their comfort zone. When we talk about entrepreneurs, that's usually more along the lines of what most of the people who attend my seminars sound like. Most people who come to my seminars who want to learn about franchising, they were probably B or C students. They've gone from job to job. They've owned multiple businesses. They drive faster, sportier cars. They've gotten tickets. They're more often divorced. And the general rule of thumb with these people is they've never seen a rule they didn't want to break. And that's sort of the entrepreneurial mindset. You're willing to take some risks. You are more of a risk taker. You are somebody who's more driven. And those kinds of characteristics are what make you successful as an entrepreneur. But at the same time, if your franchisees remind you too much of yourself, it's probably not a good thing. It probably means they're going to try and change the system on you. So be very careful about somebody who's really entrepreneurial. Now, when you're developing your operational manual, that's what the thing that's going to govern the way in which these people are going to operate. That manual is going to probably be 400, 500 pages in length at least. It's going to be a sales tool for you when you go out there. It's going to be a training tool when you're trying to train your franchisees. It's going to be a reference guide for your franchisees. It will help you to reduce liability, and it is ultimately an extension of your legal documents. So it is part of your quality control. So when you're thinking about it, think of it as a multifaceted tool that does all these things. And make sure that it's used now, of course. So when somebody calls you with a question, the first response for many new franchisors is a lot of times franchisors will say to themselves, somebody calls up with a question, they'll say, how do you install a widget? And the franchisor will say, well, the answer is X, Y, and Z. But what you want to do is you want to train your franchisees to use this as a reference tool. So instead of answering, which would be the easy way of doing it, as a franchisor, what you should probably be doing is you should probably say, well, have you looked at the manual yet, Mr. Franchisee? If you have not, let's pull it out. Why don't we pull it down and see if we can find that answer? If you do find the answer, then you're going to reinforce to them that no matter what, you're going to, as a first step, require them to look at the operations manual. So they'll start doing that without calling you. And if it's not in the operations manual, then good. You want to know that it's not in there so you can update your operations manual. So think about the operations manual. The table of contents of that operations manual is a required disclosure item. And the operations manual itself is great at helping you to avoid litigation if it's well written, but it can be a franchisor's worst nightmare if it is poorly written. So, and I can give you stories about this, about some of these operations manuals that created agency relationships or that had different regulations that were, or different prescriptions for how things should be done that were different than regulations because they didn't keep up with regulations, etc. So one of the things that you have to ask yourself in developing an operations manual is what you are providing a best practice, or is what you are providing a mandatory requirement in your operations manual. So there will be certain things that will be mandated in your manual. Anything that's a brand standard should be mandated in your manual. And if it's a best practice, it should be something that is recommended, but is not going to be legally enforceable. It's not something that is too prescriptive. You have to be careful of that. So I'll give you a quick example here. Domino's did a survey and figured out that one of the ways that they could reduce the amount of problems that they were having with robberies at their location was to have drop safes in the locations. So they put down that the franchisee should have drop safes. They specified, here's the drop safe that you have to use. And then one day, one of their franchisees was robbed. And when they were robbed, they were not able to open the drop safe. And it was the manager was not able to open the drop safe. The manager got pistol whipped, and following that, sued the franchisee and the franchisor, saying that it was their drop safes that was the proximate cause of their injuries. And they won. And they won because these drop safes were mandated as part of the operations manual. And so I ask people, do you think that having a drop safe is a brand standard? And when I talk about brand standard, is it a reason why people come into your location to have your pizza? Right? So I think most of us would agree that the drop safe that Domino's uses in their location has nothing to do with whether or not we're going to go into a Domino's to get a pizza. So if that's the case, it should be something where it's a best practice and not a brand standard. So it's a fine line, but it's an important one that people should do. Your operations manual should be constantly updated. One of the things that we found is that if people don't get their operations manuals reviewed on a regular basis, there can be some real problems. I mean, one of my favorite lines is by Charles Munger over at Berkshire Hathaway, who basically said that if you jump out of the window at the 42nd floor and you still are doing fine when you're passing 27, it doesn't mean you don't have a real problem. And there's a lot of franchisors out there that if you think about what they are what they're doing, they've got operations manuals that have time bombs in them that could very easily explode on them without them having the first knowledge of that. So, for example, there was a major food service franchisor that some years ago had a substantial foodborne illness issue, and this is a top name franchisor, and they ended up having an issue with E. coli, and that issue that they had with the E. coli ended up killing 6 people and injuring others. And really, the E. coli issue was not their fault. It was their supplier that actually was at approximate fault of the E. coli as contaminated meat was sold to them. But in that particular case, the operations manual was a little bit too specific about the temperature at which we should prepare the beef. And while there was nobody there taking the temperature of every hamburger that got sold on that location, because the operations manual said you must cook it to an internal temperature of 140 degrees as opposed to 160 degrees or whatever the law stated in the state of Oregon, the franchisor ended up with $160 million of liability that almost bankrupted the company and caused a substantial restructuring of the business. So when we talk about developing a best practices operations manual, this is sort of the process, and I would suggest that there's a system that you can go through that essentially allows you to define what are best practices and what are not, and then what are sort of other elements of this. But so what I would say is, I'm not going to go into a lot of detail about this, but this is essentially what the process looks like when we're talking about developing a system for the development of your franchise operations manual. Beyond the operations manual, there's a lot of tools you can use. Online training is one of the big ones these days. It allows you to review and see test scores and other issues like that. So again, quality control, making sure franchisees are doing well is going to be at the top of your list as a franchisor. One of the things we do is we encourage people to do learning management systems, and this is just an example of what one might look like. But you would look at various different topics that you would have, and those things would be relatively easily searchable. So when we talk about legal, we talked about that before. Fdc Rule 436 requires that you have a disclosure document and that you provide that disclosure document 14 days prior to the sale of the franchise. The final franchise agreement, without any changes in contract terms, has to be provided 7 days prior. The FDC rule talks about what you can and cannot say in terms of financial performance, and everything that you say as a franchisor has to be consistent with what is in that disclosure document. In addition to the federal law, you're going to have to comply with the state law. So the state law, basically there are 14 registration states. These are the states that regulate advertising. There are also some business opportunity states. We mentioned those earlier. And then remember that there are some older definitions or some older laws and some other laws that are a little bit unusual. So you have to be careful in terms of the way in which you are looking to comply with these laws and make sure, again, this is where having a great franchise attorney is important to you. Now, the state laws, they can be triggered for a variety of different reasons. Where you're incorporated, where you're domiciled, where your franchisee lives, the territory that's covered by the contract, or where even the discussion takes place. Like in New York, if the discussion takes place in LaGuardia Airport, you have to be registered in New York, even if you are out of New Jersey and your franchisee is going to operate in Pennsylvania. So you have to understand what those are. Again, make sure you get a good franchise attorney. Track these kind of variables closely and always check with the attorney whenever you're in doubt on these things. From the standpoint of state-specific legal issues, there are certain things that you have to do. You have to be registered prior to soliciting. Sometimes you have to submit your advertising materials to some of these states. So depending on the state that you're looking to go into, there are some states that have specific laws relative to termination or non-competes or escrows. So you have to make sure that if you are doing this, that you have a good understanding of what different states are and what they will allow. And this is sort of a map that sort of in general shows you where the states are. The green states are the franchise registration states. The red states are both registration and biz-op states. And the blue states are biz-op alone states. A lot of times there's trademark exemptions in these states. So Florida, Georgia, North and South Carolina, Connecticut, Maine, and Utah all have trademark exemptions. So if you have a federally registered trademark, you don't need to get registered there, that kind of thing. But this gives you sort of a visual about the states that you have to be cognizant of. And I mentioned before a little bit about financial performance representations. Item 19 of the disclosure document is what used to be called an earnings claim. It's now called a financial performance representation. But you cannot say anything about your earnings or your sales or your expenses unless you've covered it in item 19 of this. There's going to be certain things that will be covered in item 7, like your startup costs, but you have to make sure you understand what you can and cannot say. Now, there are certain advantages to using an item 19 earnings claim. Might be able to help you sell faster or avoid litigation, but it's got to be appropriate. And one of the issues that is particularly vexing these days is, what do we say if our business had a down year, but the reason it had a down year is because of COVID? So there's different opinions on how you can do that. And I'm not going to go through the whole COVID discussion here, but you can still have those conversations as long as they are disclosed properly. And you just need to make sure that you've done that in a way that is not misleading to a prospective franchisee. There's probably 40 to 50% of franchisors who don't use financial performance representations anymore. So there are certainly ways in which you can do that. So that's not necessarily something that you have to do. Bear in mind that there are significant fines and penalties for anyone who fails to live up to some of the franchise laws. Some of these things can be very substantial. And so you have to be very careful of exactly what it is that you're doing and make sure that you understand. Again, this is where a good franchise lawyer comes in. Now, when it comes to marketing your franchise, again, one of the things that we talk about is that you want to support your franchisees, number one, first and foremost. So we usually tell people start locally and then go regional from there. So you want to be able to cluster your support. You want to be able to have franchise advertising economies, purchasing economies, brand building, and a brand awareness. But you also want to be able to provide that support in a ready manner. So if you are operating out of New York and you have a franchisee in California, that means you've got to take a full day flight to get out to California if they have a problem. You have to spend the full day with them, and then at the end, you're going to take another full day flight coming back. You've wasted 3 days just to have a one-day meeting on site with your franchisee. And it's very expensive as well because you pay for a long airplane ticket and you've also paid for 2 nights in a hotel. And what we normally like to see is somebody within about a 3-hour drive time in the first year, maybe the first 2 years. And that's where you should be focusing your efforts until you get to a point where you're ready to expand beyond that. And again, don't expand faster in your ability to support your franchisees. Nothing works as well as in selling franchises, happy and successful franchisees, and make sure quality control and their success is at the top of your list. From a standpoint of marketing effectiveness, you want to narrow your prospects down as much as you possibly can. So from the standpoint of doing that, if you're already franchising, survey the characteristics of your top performers. If, on the other hand, you have not yet started franchising, survey the franchisees of your competitors. You can learn a lot just by looking at their LinkedIn profile or, ideally talking to them on the telephone. Make sure that from the lead generation strategy that you're selecting the right strategies. That's where, again, companies like ours that have accumulated hundreds of thousands of leads over the years have a pretty good feel for what some of those are. Make sure your advertising is appropriate, and make sure you're using the right media, based on the development strategy that you are trying to employ. So one of the nice things about franchising is a lot of people are out there looking for new brands. They're looking to buy into the next new concept. 40% say joining a known brand is not vital. 40% would prefer a known brand but are open to newer concept. And there's a group of people that only want known brands, and there's a group of people that only want new brands. So just in terms of your average candidate, have them visit you. Virtual discovery days are becoming more in fashion these days, but you really do want to make sure that you're at least involving all your people in this conversation. In a normal world, 10% of your franchisees are looking because of job loss. In today's world, that might be 30 to 40% of your candidates or more are looking because of that. One of the things that we talk about is that franchising really thrives in a recessionary environment. And the things that drive franchising is people being out of work, which we got very high levels of unemployed people at about 7.5% now. Plus that's about 11 million people. Add to that another 3-4 million people that are underemployed. Second thing that's going to drive it is the availability of capital. And unlike the last Great Recession, we've got a great deal of capital availability today. Third thing is cost of capital, which the cost of capital is substantially lower. Fourth thing is going to be the collateralization of the capital of the loans, which, unlike the last Great Recession, we've seen records in the stock market and records in the housing market. So this is really a great time for most franchisors that are out there. Now, again, make sure that your franchisees talk to your current franchisees. And so here's just some quick, not some general high-level information about what it is that people are doing to market their franchise. You'll notice that about 50% of lead generation spend comes from the internet or the franchisee website when you add that together. And if you add in social media on top of that as well, it's going to be well above the 50% level. So those are that's the main driver of leads these days. But when you find and especially when you talk about leads, you see that the leads are coming in at less than maybe you want, but they're still coming in at above that 50% rate for leads by media. But if you look at where on the internet people are spending their money, one of the things I would tell you, franchise opportunity sites, you have to be very selective in terms of the franchise opportunity sites that you look at. A lot of those are going to have very low conversion rates. So that is something that we have found is not as effective on some sites as others. The other is the social media advertising. While people are doing more and more of it, it is not getting the kinds of close rates for most businesses that we would hope for. Social networking, again, is another area that is not getting the highest levels of close rates. The email, the SEO, the pay-per-click tend to do better. And some of the franchise opportunity sites are doing pretty well as well. When we look at franchising in general, from a lead generation standpoint, one of the things that we talk about is the sort of the pipeline of where the leads come from. So what has happened in the last year is not very reflective of what we're seeing in a typical franchise environment. So what we're seeing in the last year are very high cost per leads. So the year before, we see a cost per lead here of about $312. The year before this, it was $134. But what's happening is people were spending more money on franchise marketing, or continue to spend money on franchise marketing, but fewer people were actually interested in buying franchises at the beginning of this recession. Some of these other numbers are fairly consistent, but in terms of sort of close rates and time to close, it's taking a little bit longer to close in today's market. from the standpoint, it's usually 12 to 14 weeks to close. It's now 18 weeks for close time. And the average marketing cost has gone up to about $12,000 per franchise sale, with a median of about $9,600 per sale. So those numbers are higher. Average close rate's about 3.5%, which is also higher. And that 3.5% in an average year, those numbers usually are closer to 2%, 2.5%. But we're seeing a higher number today because the people who are buyers are actually, there's more buyers as a percentage of total than there are non-buyers as a percentage of the total. So there's fewer tire kickers, I guess is another way of saying it. Now, one of the things we're expecting is in 2021, we're expecting that this cost per lead is going to go down substantially as more and more people start looking at franchises. And so we are expecting that we're going to see these same kind of numbers here, but we're going to see very low cost per leads over here, which is going to result in a substantially reduced marketing cost per sale. And lead times maybe continue to stay fairly long, but we are looking at some substantial reductions. This is sort of an unusual year to be launching. So in terms of closing costs, you'll see that these numbers have gone up, up, up. If you look at what happened sort of during the Great Recession, the numbers jumped up to 13,000, and then immediately thereafter, they had a substantial drop in the following few years after the last recession, just based on sort of what we normally would anticipate. And we're anticipating a similar kind of drop in 2021. From the standpoint of marketing, one of the things I think is important to point out, most franchise companies don't have an unlimited marketing budget. So the circumstances are going to be very different in terms of what it is that you need to be looking at, your budgetary restrictions, your geographic focus, those kinds of things. So it's important to have a really fully integrated lead generation strategy to be able to substantially, hit the kind of goals that you're looking for. So it's not really, what we're looking for is not some kind of canned approach in this process. Obviously, the web is the centerpiece of your strategy, and there's going to be everything sort of will feed into the web. So it's important that your website has some kind of a plan to attract traffic specifically for franchising. One of the things that we do recommend is that you have a dedicated franchise website. It should not be a extension of your consumer website. And the reason for that is that, frankly, Google gets confused if it's hearing two messages from the same site. So if it's hearing from the site that it needs, that you're looking to sell widgets, and then it's also you're looking to sell franchises, Google says, are they a widget company? Or are they a franchise company? So we recommend doing a separate site with a separate URL. It can look pretty much identical to what everybody else would normally see, but it would also be something that is, from Google's standpoint, something where it's clearly differentiated. From a standpoint of SEO, if you get caught on the last page, on the second or third page of Google, chances are you're not going to get found. So it's really important to do SEO. Typically, pay-per-click advertising is a great way to get on page one, but those costs go up over time. With SEO, those costs go down over time. So they typically start out more expensive, but then as you continue to build backlinks and other kind of content, then typically what you're going to find is those will go down. So in terms of sort of ranking factors and the kinds of things that are sort of positive SEO correlations, and again, this is the kind of thing that our sister company, Top Farm Media, does. It's the number of sort of keyword links. It's a lot of it is social media these days are some of the biggest things that are out there. But bear in mind, again, SEO is a process. So when we're talking about sort of the process of search engine optimization, what we're really talking about is continuing to refine the way that your business is working, adding more content, and sort of continuing to add more content as a part of the process that you're doing. One of the things that we are offering as a part of our seminar today is an assessment through, from some of our affiliates over at Tom Farm Media. So if you want to get a second set of eyes on your online marketing presence with a focus on the franchise side, we will do an inbound marketing assessment that will take a look at social media, pay-per-click. We do this assessment at no cost to you. So if you want, just send an email to us and shoot along some of your contact information, and I'll have somebody reach out to you to get that assessment taken care of. From a standpoint of messaging, bear in mind that franchise marketing is going to be very different than consumer marketing. So I saw a brochure the other day that had a number of barbers sitting there waiting in a beautiful, pristine barber shop, and it was obviously a barber franchise. I thought to myself, boy, this is great. I need a haircut. This is just exactly what I'm looking for. But as a franchisee, it's sort of a franchisee's worst nightmare, because you've got all these barbers there and nobody in the chairs, no money changing hands. This is what a franchisee wakes up screaming about in the middle of the night. So again, make sure that you do this, but do this within the realm of what the franchise lawyers will let you do. There's basically 5 sales you're making as part of your messaging. The first is you got to convince people to go into business for themselves. The second is that you want them to go into business by buying a franchise and understanding the benefits of franchising. The third is they need to invest in your particular industry. Why is your industry so great? And fourth sale is why do they need to invest in your specific franchise? So think about those 4 sales as part of the content development side. And the last sale, which is more relevant today than normal, is what is the timing on this? So from the standpoint of timing, we look at, is the timing right for us to be getting into the market in the middle of COVID? And that's something that people are going to be asking themselves depending on what it is you're doing. Now, remember, your attorney should review all this stuff because the registrations will review this stuff. Again, make sure you got a great franchise attorney. Lastly, I want to talk a little bit about selling franchises. And when we talk about franchise sales, this is sort of where you're starting. You're telling somebody, I want you to quit your job. I want you to give up your vacations, your 401k, your benefits. I want you to trust me, even though we've never met before, to invest your life savings and go into a business where you have no experience and where, frankly, you're going to make the equivalent of a lifetime commitment. Now, if you think that sounds like a tough sale to make, add to that the fact that you're going to say, oh, and by the way, I can't tell you how much money you're going to make, right? So it's a place where there's a lot of distrust and where franchise prospects are, starting with a very sort of worrisome attitude. That being said, franchise sales are very predictable. So when we talk about franchise sales, essentially, when you talk about it, you start with a good concept and the right message and the right marketing plan and an adequate marketing budget, and you use good sales technique with that, and you're going to get a predictable number of leads, which will translate to a predictable number of meetings, which translate to a predictable number of franchise sales. Now, these averages are some very old averages, but there aren't any newer statistics that have been out there. But basically, they say that the average new franchisor will sell 9, 11, 13 in the first 3 years, and the median number of sales are 4, 5, and 6 in the first 3 years. So it's not, if you're going into franchising and think you're going to sell 100 franchises in the first 3 years, that's really not typical of what franchise growth looks like. Now, this is maybe a different representation of the same thing that we just talked about, and that is sort of our sales and success cycle in franchising. And essentially what we say is that if you start with a great value proposition, that means a concept that works, you structure it so the franchisee makes money and so that it's attractive. You have a good marketing plan, which is the kind of thing that we do at iFranchise Group, and good messaging and good materials, and a good sales process. The only thing that's a variable here is the advertising expenditures. And remember, we talked about the predictable number of leads and being able to predict that. So to a large extent, the more money you pour into the franchise advertising budget, the more franchisees come out the other side. And so that's the only real variable if you do everything else right from the standpoint of the franchise sales cycle. But post-sale, once you've sold that franchise, you have to train them, and hopefully the selectivity that you've exercised is going to make sure that they're easier to train. You've got to help them with opening. You've got to help them with support. You've got to communicate with them. And ultimately, you've got to make sure that they are successful so that they validate for you. And that's sort of industry jargon for the franchisees are going to say good things about you. If franchisees are all saying bad things about you, then your concept, regardless of how good it works for you, is not going to play well in the franchise marketplace. If everybody's saying I lost my life savings and the reason why was the franchisor, well, if they've lost, those kind of conversations aren't going to make for a lot of franchise sales. It won't make any difference how good your marketing plan or your messaging and the sales process that we design for you are. If you don't have good validation with your franchisees, you will fail as franchisor. So what we tell people is the number of franchises that you sell really has nothing to do with the averages. What it has to do with is how much money do you spend on advertising dollars down here at 5 o'clock. At the same time, the one thing that we call that should be your capacitor on growth is going to be this back half of the cycle, which says, here is how fast we can afford to grow and still make our franchisees successful. And so that's really what we're looking for there. Now, again, when we talk about selectivity, make sure you understand that you're trying to award a franchise. One of the first lessons of franchise sales is that you'll find out nobody's ever sold a franchise. But really, the psychology here is that it's a two-way street. Somebody's got to qualify for your franchise. They got to follow your rules. So you don't want to be seen as a salesperson. You want to be seen as somebody who's facilitating that award. This is something they're investing in, not something that they're buying. So it goes into all of sort of the nomenclature that you're going to use as far as this is concerned. Understand what motivates the franchisee in this process. Obviously the value proposition in terms of systems and operating economies and shared knowledge, and those things are going to be important. But bear in mind that a lot of this is assuming that a franchisee looks at this from a logical perspective. And that's oftentimes not the way a franchisee does their buying. Sort of a logical franchise buyer would have sort of a process that they would go through where they would say, here are my investment requirements. So you can go through due diligence, look at the whole universe, narrow it down, and then finally get to a decision on the purchase. But the emotional reality is that people buy franchise in a lot of ways that they often will buy to make other kind of major decisions like their spouse or their job or their home or their car. And they don't necessarily follow a logical path. Some of these are not even going to read the disclosure document. We don't encourage that, but they won't. They are motivated by a lot of different things. And it might be they want to be independent or financial return or fun and excitement or to get out from underneath their boss. But looking at sort of the things that they are motivated by, oddly, earning more money is not at the top of the list. What we see is being their own boss and general independence are two of the things that are at the top. Doing something they love is often one of them. And then earning more money comes in at sort of a third place on this spectrum. So understand what's motivating your franchisees. That means asking them a lot of questions early in the process, finding out what it is that's motivating them. Now, when we're talking about the franchise sales process, understand that most franchise prospects are going to look at somewhere in the range of 6 to 12 franchises or maybe more. So understand that you are being shopped and make sure that you're prepared to answer how you are differentiated from the people that you're most likely being shopped against. This is sort of the flow of the franchise sales process, and the process itself is obviously has a number of different steps involved in it. Basically, it starts by with the lead coming in, we provide them with a confidential information request form, which we call a SIRF for short. Once we've reviewed that and found out that they are qualified, we will do personal interviews, background checks, we'll do disclosure and reference checks, and then we'll have a discovery day typically. There's more steps to it than this. So again, this is sort of an overview, but then, they're typically, this is the sort of overview of the process. Now, from a philosophical standpoint, one of the things I would like to drive home today is sort of the understanding of the present value of a single franchise. A lot of times there are a lot of decisions that you will make as a new franchisor where you're thinking about it from the standpoint of maybe the short term. So as an example, franchise brokers as a means of lead generation provide very high quality leads oftentimes. Those leads they provide turn into franchises at a much higher rate than the typical non-broker lead. But a franchise broker, when they close a lead, might be looking for a commission on that lead or a referral fee on that lead that might be $20,000 or $25,000. And it could very easily eat up most of your franchise fee, especially if you have to pay a sales commission to your franchise salesperson who is still involved in the sale, even though it came from a franchise broker. Well, you could lose money on every sale, and it would sound like you're losing money, right? Because your franchise fee is $25,000. You paid a $24,000 broker fee. You paid a $5,000 commission to your franchise salesperson, and you had to pay for training and everything else. But understand that what we're selling when we're in the franchise sales business is we're selling a long-term stream of income that is going to be, again, some McDonald's franchisees are third generation. They've been paying franchise royalties for 60 years. So every year there's, $30,000, $40,000, $50,000 in royalties comes in from that franchisee year after year after year. So essentially it's like when you sell a franchise, it's like purchasing an annuity. You're going to continue to get that money over time. So understand what that present value of that franchise is when you're making decisions that impact it. So if you were to look at it from just the standpoint of franchise fees, you might say that broker is charging too much. I'm not going to pay him that kind of money. But when you look at it from the standpoint of a longer term relationship, you might say to yourself that you are happy to pay a $24,000 franchise brokerage fee when somebody is in that situation. Excuse me. So from the standpoint of the sales process, when we talk about the sales process, the sale essentially is, the most important thing is be selective in terms of who you take on as your franchisees. Hire the best salespeople that you can afford, maintain a level of personal involvement in every sale. And again, make sure that both the franchisee's success and the quality that you're going to have from a franchisee are the guideposts for who to do this with. Make sure your sales staff is trained. You can have personal liability for franchise sales. So make sure that you do that. And then set up systems to measure everything. You want to know cost per lead by media. You want to know all these different elements, because if you don't, you're not going to be able to make the kind of adjustments that are going to allow you to be more effective in the sales process. Ultimately, done right, it is a numbers game. Obviously, if the concept does not work, if it's not franchisable, don't franchise it. All you will do is create problems for yourself. But franchisee success as your capacitor for growth will allow you to grow very quickly. And with those caveats, I would say that the franchise sales are a natural result of a well-executed marketing strategy and a good sales strategy. So again, that's really the process that we're talking about. Now, this is sort of a overview of sort of what the process looks like for an established franchisor if they're not hitting their marks. So if one of the things that we do with established franchisors is if we find a franchisor who's not doing a great job with their franchise sales, we try and figure out what the problem is. And so if you were to look at sort of referrals and publicity, that could indicate concept problems. If you were to look at high cost per lead in other media, it could be media selection problems. If you look at low conversion rates, it could be your marketing materials or your sales process. If you were to look at few broker leads, it could be lack of broker participation and going to the broker shows, or it could be broker confidence in your sales process. If you have a long close time, it could be an inability to create urgency or setting an agenda up front, or poor closing skills. Low conversion rates could be poor sales skills or poor validation. So in short, if you understand and you track everything, you can figure out exactly where the problems lie in any of the different areas that you're looking at. But if you do not track these things, you're just left with a problem where you say, it might be the leads, it might be the salesperson. I don't know why we're not closing at the rate we should be closing. So this is why it's really important to track every single statistic. And when we do a marketing and sales audit, what we will do is we'll look at 4 primary areas: the franchise concept, lead generation, the messaging, and the sales process. And each one of these could have certain potential problems. And there are certain symptoms that go along with each one of those issues. And there's a way that we go about diagnosing that by doing different kinds of surveys, or by evaluating portfolios, or evaluating contracts, or doing marketing comparisons or contract comparisons. The same holds true for lead generation. We know how to identify those symptoms, and we can diagnose it by applying historical norms, or messaging versus competitors, or performance versus competitors. Same holds true for marketing materials. Same holds true for the sales process. So each one of these things are, there's, obviously 20 plus problems that you could have in the sales process, and there's really more than that, and multiple kinds of symptoms. But again, it's very important to track where those symptoms come from. Once you've confirmed what the problem is, though, the good news is there are solutions for each one of these things. So again, I don't have time to go through this in detail with you, but there are different things that can be done in each one of these areas to make sure that the franchisor is able to not only identify where those problems are, but also to be able to figure out how to solve those problems and to start selling franchises. So that is essentially, the process of franchising. Now, when you're first getting started as a new franchisor, one of the things that you're going to want to do is put together a series of documents that are going to help you to become a better franchisor. And so when we look at things like that, essentially what we're looking at is a process that can be, can vary fairly substantially based on how aggressively you're looking to grow. So typically there's 5 major things that you need to do to be a good franchisor. The first is you need to develop your strategy, and that's things like what your fees and royalties and territory and structure are going to look like. The second thing is you need to develop the legal documents that'll be a piece of this. And that's a franchise agreement, disclosure document, and then state registrations. The third piece is the development of quality control tools. That usually starts with the operations manual, training programs, train the trainer programs, training videos, and an online learning system. Then it's, how do we market the franchises, developing e-brochures and marketing plans and sales videos, and making sure we've got a good, strong website. And then making sure that everybody's on the same page in terms of how we sell and what sales messaging is, and how we implement, and sort of ongoing consulting. And this is the kind of program that we do for clients who are getting into franchising for the first time. Now, you notice here that it says for aggressive growth. This is for the kind of company that's looking to sell 20 plus franchises in the first year. This is not what we normally recommend. We normally recommend a more conservative approach. But this gives you a feel. This is the one piece of this that we don't do, which is the legal documents. And again, I would provide you referrals to those folks, whether you choose to use us or not. I'm happy to do that. So once those are completed, this is essentially would give you all the tools that a company like a McDonald's would have. So beyond that, if you wanted to be more moderate in terms of your growth, you would eliminate certain things. You eliminate the videos, you eliminate the online learning systems, you eliminate some of the training tools that are meant for taking on lots of franchisees at one time, and you can cut your costs down substantially in this process. If you want it to be even more conservative, just want to start walking before you run, maybe you're going to sell to some prospects that you've already identified or some former employees, this might be more of a starter kind of program for companies that are just getting into franchising to begin with. What I would tell you is that the process, fees for a company like ours can range from $20,000 to $200,000 plus, depending on how many videos you're doing and doing online learning systems and doing all these other things, or if you're just doing like one little piece like an operations manual. So it's really sort of a function of how aggressively you are looking to grow as to what kinds of capital that you're going to need. Now, what I would tell you is that when it comes to making a decision to franchise, a little bit of fear is normal. And I think that anybody who's taken a major business decision like this is going to have a little bit of fear. I remember when I was a kid, I remember, and I put this up here on purpose, I remember getting up to the top of the diving board, and it looked like so much fun when all my friends were doing it. And then when I got up to the top and I started looking down, it's like, boy, that looks like a long way to go. But everybody's up there and sort of saying, come on, Mark, you got to jump. And so ultimately I did, and found out that it wasn't so bad. It wasn't so hard. And frankly, it wasn't so much different than what I had been doing off the low board the whole time anyhow. It was just a little bit further distance. And so I think that's sort of normal in franchising. A lot of times people in franchising think that becoming a franchisor is really a sort of, a major shift in the way that they do business. But going back to the sort of thought of how fast you're selling franchises, the transition is usually pretty gradual. I say it's sort of like walking out into the ocean. You start by getting your ankles wet, and then you're up to your knees, and then you're up to your thighs, and eventually you're swimming. Well, when you're first starting to franchise, think of it from this perspective. If you're looking to sell 10 franchises, let's say 12 franchises in your first year, which is a pretty aggressive growth program, and let's say you've got a 3% close rate, that means you need to have about 33 franchise prospects per month to be able to sell a franchise. Now, so what you would end up doing is you'd end up spending, enough money to get 33 franchise prospects, maybe $10,000 in January, 10,000 in February, 10,000 in March. And the way you're going to start in franchising, day one of your life as a franchisor, you're going to pick up the phone once and you're going to be done. Or you're going to send out one email and you're going to be done. And that's going to be it. Day two, another email, another phone call. You're going to continue that along that route. Most of the people that you talk to are not going to be qualified, and so you're going to, let them down in a nice way, but let them know that they're not ready for prime time, and that you're going to, they were going to have to think of something else to do with their lives. They're not going to be your franchisee. About 14% will be people that, just based on the averages, that you would want to get to that next stage in your process. And so that means at the end of a month, instead of having 30 people in your pipeline, you probably have 3 to 4 people in your pipeline. And that's maybe 5 in your pipeline, and that's it. The second month is going to be the same thing. So you're going to still be doing your regular job for the first 3-4 months until you sell that first franchise. And even then, it's going to be like opening a new location, just one new location. So it's not like jumping into the deep end of the pool. It is much more gradual in terms of what happens. In terms of the cost of becoming a franchisor, your costs are going to vary based on your particular situation. So The speed of growth is going to influence what kinds of things that you would need from a company like ours. Your ability to do work internally is going to influence it. Obviously, you don't want to be undercapitalized in there. Your legal fees are probably going to run you $15,000 to $35,000. Generally speaking, the consulting fees are $40,000. They can be lower than that, but usually 40 to 200 is the range I quote people. Organizational expenses, usually they tend to be closer to the 10,000 these days. People don't do as much printing as they used to do. It's more e-brochures, so that keeps the cost down. Franchise marketing, 8 to 12,000 per sale, and you should have about a 6-month budget for that. So if you spend, again, going back to what we're talking about, you spend 10,000 in January, 10,000 in February, 10,000 in March, 10,000 in April. By the end of April, you probably sell that first franchise, or at least statistically speaking, you should. And so you've got 10,000 going out, but you also have another 25, 35,000 coming in. So you're sort of cash flow breaking even at that point because the January leads ripened in April. The February leads will ripen in May on average. That doesn't work quite like that in the real world. It's a lot more uneven than that. But if you sort of give yourself 6 months worth of working capital, that should be about what you would need from a budgetary standpoint. Then the last thing is going to be people, and you can, the needs that you're going to have are going to vary pretty widely based on how fast you're growing, how good the people are that are on your team right now, and how many of them you have, and how but mostly it's based on speed of growth. So that's pretty much the presentation. What I would say, sort of in conclusion, is that franchising is a means of duplicating success. You can't franchise something that's not working to begin with. It's got to be something that is working if you want to do that. Second, create a win-win situation. Make sure your franchisee is successful. I think now that's 4 times I've said it. If I've said it any less than 4 times, I apologize. It's the most important thing that you'll be able to do. The next thing is be selective in terms of who your franchisees are going to be. Make sure that you're selecting people that are going to be top quality franchisees. Understand that you're entering a new and different business. It's not the right solution for every business, but it is one of the most powerful and dynamic business models that you'll ever be able to take advantage of. And then in closing, what I would say is, if anybody has any questions, I'm happy to try and entertain them. I think we've got a few minutes left, but there is additional information available from iFranchise Group. We have some consultants, we call them franchise analysts, that you can talk to anytime to ask them questions. They're professionals at this. They know how to answer most of those questions that you might have. Happy to send you a copy of these slides. I also have a video on how to franchise. It goes into a little bit deeper dive on some of the strategy pieces, and a book on how to franchise. It does a lot deeper dive. Happy to send those out again with our compliments to the folks at MFV. And lastly, we mentioned before, if you wanted to get a digital marketing assessment, we'd be happy to do a assessment of your marketing to the extent that you're out there trying to search for franchisees already. So with that said, I'll open it up to questions if there are any, and let's see if I can find the. I am not hearing any questions, and I'm not seeing anything come up on my. So I'm not seeing anything. I'm not getting my chat. Chat room is not opened up with any questions. So I guess since I have not heard any questions, it sounds as if we have just about run out of time. I want to thank everybody for the time and attention that you've given me today. And if anybody is interested in learning more about franchising, I'd love to hear from you and talk about whether or not franchising is right for your business or whether you have any other alternatives that might make sense. So again, thank you for your time and attention today. And everybody out there, please stay safe and hopefully business gets back to booming for you if it's not already.